Apparently, the housing bears are wrong. Let's have a look. Hello everyone, Florian.heise here, and welcome to another episode of HeiseSays. I have my stein of coffee, and I thought we'd have a look at this opinion piece from the Australian Financial Review, prepared by Christopher Joy, discussing his arguments that housing bears are wrong, and essentially meaning those that are predicting a decline in housing prices are incorrect. So let's have a look, because it's quite interesting, particularly considering the banks are definitely preparing for a housing decline. Construction of new homes, cancellations are up 30%, which is double, almost double, where it reached in the GFC. Unemployment and underemployment is sitting at 25%. Tourism is non-existent. The economy has ground to a halt due to lockdown. But apparently, people concerned that housing is going to fall are wrong. Let's have a look. Let's see his arguments. The big financial institutions are predicting a huge slump in residential property. But as the search for yields intensifies, gross rental returns of 4 to 5% on investment properties are attractive, as are some hybrids. Are we going to continue to see these rental returns when the market is being flooded with Airbnb properties that are joining the long-term rental market, where more people are moving back home or more people are living together, boarding together to save money, where migration is non-existent? Won't that have a demand on the rental returns? The Great Virus Crisis, GVC, has been one of those historic dislocations where heavy-duty intellectual firepower has really counted. The ability to properly phrase the data, forecast infections around the world, and anticipate policymakers' reaction functions has been incredibly valuable. How? We're only seeing the beginning of this process. And anticipate policymakers' reactions? Well, has he anticipated the sharp stop in free childcare, the sharp stop apparently in JobKeeper? Have those been anticipated? How's the market responded to that? In this context, a familiar debate is once again raging in Australia. I'm being circled by a pack of very hangry housing bears. They are all confidently growling that local house prices will slump by the largest margin on record. The four major banks claim prices will fall by at least 10%. UBS forecast a 10% to 20% retrenchment, after failing to anticipate the 10% jump in prices over the past 12 months. Morgan Stanley reckons prices will slip by up to 15%. Well, remember, here's the thing. With property prices, it's the edge cases. We're not seeing the real ramifications of this economic lockdown or the job losses, because the banks are giving people mortgage holidays. AMP's Grizzly Shane Oliver is once again calling for prices to fall by as much as 20%. Respected housing analysts like my friend Lewis Christopher are open to the possibility of a 30% drawdown. And then there are the perennially negative perma-bears, praying for the mother of all housing depressions, including doomsayers like Stephen Keane and his acolytes. I mean, it's entertaining, at least how he's putting it all together. I mean, guys, I wouldn't consider myself a perma bear. I would love property to shoot up and to get free money from just sitting on my house. I really would. It's easy. Seriously, when you compare it to actually running a business, working hard, or even just my little hobby here of making YouTube videos, it's not work. You just sit there and boom, you just make money. Oh, look, 30%. Oh, look, nearly 70% profit made. Fantastic. Fantastic. But I just can't see the fundamentals. I just can't see it, where all these things that are meant to be, well, that is facilitating our property growth, they're all falling off. China, Chinese and Australian trade, that's going to come at risk. Will that drive our property up? Foreign investment into our property sector was bloody high, guys. Bloody high. That's, while the Chinese are still investing in Australian property, They're still snapping up our property, apparently, or search results are saying that. Will that continue? Anyway, yet since I've pulled out my empirical shoddy and intellectual 12 gauge, the bears have started running for the hills. In fact, I'm getting increasingly excited about the prospect of making myself a bear barbecue. Our base case is that Aussie house prices will flatline over the next few months, with the risk of a modest softening of prices by up to 5%. Okay? Why? Thereafter, we forecast that 2019-20 boom will reassert itself, with prices climbing by another 10% to 20% on the back of a 75 to 150 basis point reduction in mortgage rates over the past year. So he's hoping that the cash rate crash, which has just reduced the cost of mortgages. I mean, now it's just the cheapest time in history to borrow money. But if you can't service those mortgages, this has massively boosted purchasing power, pushing down interest repayments as a share of disposable income to their lowest level in decades. Yes, but unemployment and underemployment is right now sitting at 25%. If you can't service the loans, it doesn't matter how cheap money is. It doesn't. Isn't that common sense? Isn't that fundamental? So, can't bears read data? The data is supporting our contrarian case. Okay, I'll be interested to see. In contrast to the bears' gloomy expectations, national house price appreciated in February, March and April, and in May they've been flatlining. Yes, the data's out of date. The data's lagging. Look at the unemployment data we looked at, guys. You know, I'll bring this up here. You know, the unemployment predictions from the RBA. The data is from the latest data that was just released a few days ago was from the end of March to April. It's old. This is just saying property's lagging. In fact, we've seen a picture of stability since mid-April. This is true in Sydney and Brisbane, with only modest softening evident in Melbourne. Auction clearance rates also appear to be recovering as we exit containment. Well, auction clearance rates are always, well, they're not accurate. They just show the trend. And there's always a positive bias in it. You know, we looked at that in previous videos. So we can read that data and we can understand that data perhaps a bit better than the people that are putting it out. We'll understand the reality of the data, the fraudulent aspect of the data. They're not being very clear. And property's delayed. But, I mean, how is this relevant anyway? Who cares, guys, when people haven't been forced to sell yet because of bank holidays on their mortgages? I've got another episode where we'll look at the record number of people refinancing. The 4 to 5% gross rental yields available on Aussie investment properties, arguably the best performing asset class during the GFC, are likely to appear attractive as the search for yield intensifies after the RBA's decision to floor the cash rate in March to its effective lower bound at 0.25%. But rents are going down. We're seeing this everywhere. Rents are reducing. Airbnb are flooding the market. Will that 4 to 5% continue? The normalization in housing should accelerate following our projected peak in infections in early April and the aggressive flattening of Australia's curve, which has allowed Prime Minister Scott Morrison to pivot away from his original 6-month hibernation plan to a much earlier than anticipated exit from containment over May and June, they argued in March. So, but then we just looked at data from the HIA where project cancellations are at 30%. Consumer confidence is in the gutter. And there's a big lead time into new product coming on. And sure, we're opening the economy here, but where's the migration coming? Are the international students going to return? I mean, could we see a little spike in property in their make-believe numbers that they push out every day when the economy returns? Of course we could, but what's it going to be in 2020 if things go bad? So yield hunt. The revival of the search for yield dynamic was evident during the week, with exceptionally strong interest in Macquarie Bank's new Capital Notes 2 hybrid security. Macquarie ended up issuing only $500 million, juxtaposed against investor demand of close to $2 billion. MLBP priced on a chunky credit spread of 4.7% above the quarterly bank bill swap rate, which provided for a grossed up annual yield of 4.8%. Importantly, this spread was materially above the circa 4.2% margin offered by major bank hybrids, with similar expected maturities of around 5.5 years. While this is a one-notch difference in Standard & Poor's credit rating on those securities, S&P rates the major banks' hybrids as the investment-grade BBB negative level, while applying a one-notch lower, high-yield BB+ rating to Macquarie's securities. They trade similarly on the ASX. Technically, S&P only rates the unlisted version of these assets. This is likely because Macquarie's yields have a lower franking rating and a correspondingly higher cash component as a result of its unfranked offshore earnings, which can be appealing for some. In debt market, Macquarie is also increasingly considered a fifth pillar, with its A+ rated senior bonds just one notch behind the majors' AA senior securities. Here, there is a case to be made that Macquarie has a superior risk management track record than the Big Four. Since the global financial crisis, major bank hybrids have traded on a credit spread of around 3% over the bank bill swap rate, with Macquarie securities recently priced in line with the majors' curve. If these spreads continue to mean revert back to the post-GFC averages, which is our best case, MPLPB holders will capture substantial capital gains. Major bank spreads have compressed from their historic highs in March 2020, around 8.4% above bank bills, to 4.2% over in May. We net bought $294 million of bank hybrids between late February and mid-April as investors were rushing for the exits. And then he's looking at protection for bond and hybrid holders. And I won't really go through this because it looks like his fundamental argument is that, well, because there's a demand for yield and the bonds and hybrids from the bank, are safe and secure. Essentially, the risk is manageable. That he's not going to see a decline in housing. He's not going to see a decline in housing. But what I don't understand is why there's no consideration of the fundamentals. Are the fundamentals not important? Or the fact that we're going to start seeing edge cases where people are being forced to sell simply because they can't afford to sustain these debts and these loans they have on properties over an extended period? Why that's not considered. And we really haven't seen the beginning, or we haven't seen the real economic impact of this. We'll have to see it in 6 months, in 12 months, what happens. So what do you think, guys? What do you think? Do you think we're going, the property bears are wrong? Is the data telling us it's all good? Do we trust the auction clearance rates? Are we confident in the bank's protection for bond and hybrid holders? Or do you think perhaps there's some fundamental things that will come to play that we haven't seen materialize yet? We'll have to see, guys. As always, let me know your thoughts and opinions in the comments below. Please like, share, and subscribe to the channel. If you're a fan and you want to support us, there are a few ways you can. You can join the channel on YouTube or on Patreon. You can support us via our affiliate links at Amazon or eBay or Independent Reserve. You can buy our merch from HeiseSays, support us via PayPal, or use Gold Pass from the Perth Mint. I'll see you all next time. Bye for now.